be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Drew Meredith, how you going?
Good, great. Good to be here.
Oh, yeah, one thing I forgot to tell you, this is actually live.
Yeah,
I
that's
did it
fantastic.
record. It's a Friday arvo,
Right.
so the team doesn't have time to edit it, so we're going to do it live. How you going?
Excellent. Lots been
Yeah?
happening. Been a few
Yeah.
weeks off.
Yeah, you've been
Feel
on a
like-
junket.
Feel like I think your junket was longer than mine.
My junket was indeed longer than yours. Where'd you go, mate?
Well, just Europe
Europe.
and then
Now,
Sydney. Yeah,
yeah, right.
just Europe in general.
What were you doing over there?
Holiday. It was fantastic. Weather hadn't quite taken off yet. The tourists hadn't quite taken off yet. So tried to visit as many wine regions as you can fit in 2.5 weeks.
And how'd you go with that?
3. I think we got to 3. That was it.
Okay. And what was your favourite amongst the wine regions?
I'd have to say Champagne or Reims. Reims, the
Sure.
home of Champagne. Massive chalk caves, like underground, and it was beautiful.
It's I mean, all of that part of France and Italy, pretty special areas.
Yeah, definitely. It's like we were saying, like maybe I won't say some of the scenery in Italy is better. You know, how different it is, but then the culture is very different between the two countries as well.
Do you spend a lot of your time drinking wine when you're on holiday?
Probably more than I should. It's taken several weeks to, probably the same as yourself, getting back into football and sport and basketball. It takes a while to recover from that, particularly as we age. I'll put you in my bucket too.
Oh, Jesus. That's okay. I see how this is going. Yeah, no, I don't really drink that much wine, to be honest. I don't mind a bit of a Chianti, which is the wine region that we went to, but
I ate a lot of food though. I was following your Instagram stories on the way through.
I think once you hit 30, 40, 50, 60, 70, all you've really got is food and drink. So let's be honest, guys. Get into it. No, but it was very busy in Europe is probably my big takeaway. Incredibly busy. And that's why I think I preferred being outside the major cities rather than in them.
We met someone recently in our office who does like travel experience bookings, and he's like the luxury travel and kind of and we're talking about probably inflation too. The older and retired generation are traveling en masse at the moment, but like the middle groups are starting to have been where there's less traffic coming through, but we are seeing falling airfares across, I think, Europe and America in the next 3 to 6 months.
Interesting. So if I had the little buzzer, I'd play it now and give that as a prediction.
Yeah, we went at the wrong time.
Yeah. So today we're going to be answering some questions, actually, Drew, and we've joined by
for the warning.
Marco, Mike, and Thomas in the chat. So g'day everyone else that's watching as well. So we're going to talk about some ETFs. Drew is giving us his latest high conviction stock recommendation. He's also someone sent in a question in advance. Someone was coulda, woulda, shoulda, and they said feedback today. No, Drew equals boo hoo. I don't know if that was said.
Does it mean they want me to be there or not be there? Yeah.
I think that was a sarcastic comment. G'day, Luke, over on Facebook. G'day. Who we got? Stephen, everyone watching with interest.
Have your listeners gone up since 2 cents wasn't on?
Yeah, actually, that was one of the big regrets.
Through the roof.
I was like, shit, I better bring Drew back on the show. Oh, no. Look at those analytics go down. But no, it's we got a lot of questions to get through, including we're just going to check in with some of our friends being Zip and Dubber. I haven't actually looked at Dubber recently, but last I heard it was interesting.
The car parks are still there.
Anyway, Drew, you said in the notes for this week, inflation hotter than expected, and you're not talking about Greece. So give us your economic headline, mate. What is it? Unpack it.
Man, there's a lot happening in Australia versus the US versus New Zealand. So Australian inflation seems to be stickier, but at the same time, they were saying the same thing about US inflation about 3 to 6 months ago. We just seem like we're 6 months behind, but we keep thinking we're at the same level as the US. I think inflation came out at I think it was 4.1. Again, a monthly inflation. 4.1 versus like 3.8 was what was expected. And then automatically that triggers this need to increase interest rates because another 25 basis points, less than 5% of the current rate would have a major impact on that.
Mhm.
But I think bond yields initially spiked, suggesting people were expecting another rate hike, and then they went the other way. And then we had unemployment data came out. If you saw that last week, where unemployment increased, but 50,000 more people found jobs at the same time. So I think my call of no call remains the right call,
Interesting.
in Australia at least. We talk to clients all the time. It feels like, yes, there might be one or two more at some point, but over the next 12 to 18 months, it's more likely to be flat and nothing to happen unless something seriously goes wrong with the economy.
Yep. Trunk says, will this be uploaded and recorded later? Yes, it certainly will, my friend. It definitely will. It's always recorded and it goes to YouTube, mate. Yeah, it's interesting. Like, I tend to pay attention to when it comes to the economy, there's a few things that matter to me. What's going on with the Aussie dollar,
Yeah.
which screwed you and I over because it started to rally just when we got back from
Yeah.
holidays. Secondly, obviously inflation, which leads to monetary policy, aka interest rates. And for those of you that don't know, there's basically like Australia and everyone else. So at the moment, across the major economies, even New Zealand, so New Zealand, the US, UK, Australia looks like we're holding firm, maybe even thinking we might push interest rates higher, as Drew was alluding to, while at the same time everyone else is thinking of cutting. And typically, if you want to remember something from this episode, it's that typically the currency rises from the country which keeps its interest rates higher. And that's not necessarily like the actual level, but where people think the interest rates are going to go. So at the moment, people think interest rates are going to stay high in Australia, and people think that interest rates are going to come down overseas. So keep that in mind. That's what I would say. As for what else is on your desk, mate, you did put some stuff in the notes about market returns, and I couldn't decipher exactly what your chicken scratches were trying to make out, but I did kind of see that it looks like the ASX 200 is near an all-time high, which is
Well,
good news.
it's how quickly things happen around here. I think we had gold price at an all-time high, the S&P at an all-time high, the NASDAQ, maybe MSCI, and the ASX 200 smashed past 8,000 points this week, and then a day and a half later, and we're falling off again. It is how quickly it all happens. But I think it was like super interesting. Whenever we end of a financial year, we always look back, and I don't think anyone would have predicted the types of returns that came in the last 12 months, or the amount of things that are all-time highs, given the backdrop of high inflation, massive increase of interest rates, even though they've probably changed less over that 12 months. So the ASX still did 8% or 7.8%, ASX 200 for the financial year, and a very few would have predicted that. The S&P 500 did 22.7. We could play an over/under, but I've already spoiled it. And I think it's kind of strange. So you've seen the notes. Two sectors that are kind of diametrically opposed were the top performers, and now one of those sectors is getting a lot of questions around valuations.
What did you predict? I can't remember from last year. Normally, when you make bold predictions on this show, I go, "Hey Siri," and then I set a reminder to myself. In 1 year, can you remind me that Drew thinks Zip will be $100 a share? And then hopefully Siri will say something.
Unless you change to Samsung or something.
Siri just did that, so it's recorded that. But normally I do that, and so this time I haven't taken it on board. But I think
I think I said healthcare.
Yeah, pretty sure. We'll have to wait till the end of the calendar year. But for folks that don't know what we're talking about, we normally make bets against each other. In terms of the sectors, I think it was quite interesting. You've got some dogs from the ASX, Drew. What were the dogs?
The dogs, and this is, I think, mainly the kind of the medium to large cap, and a very big spread. So the retail sector actually 23% for the financial year, but the worst performer was Fletcher Building, down 44%. So that's like a New Zealand and global producer. I'm not sure. It's not Gyprock. It's the other businesses, isn't it? For
Sorry,
Fletcher's Building.
I was just responding to Stephen. Yeah, Gyprock, no.
Yeah, and then Star Entertainment. I mean, if you read anywhere around the news, it doesn't surprise you. And they had I think their gaming machines went out unexpectedly over the weekend as well. That was down 55%. And then a kind of a diverse range of tech and construction. So Lendlease is having troubles in the construction sector, also in the news at the moment.
What's new, eh?
And then IFF, so the asset management financial services. So there's no like wide story that all tech did bad, all financials did bad. It's just kind of very stock specific issues that we saw this year.
Mm.
Would you be buying them as the dogs of the Dow this year?
Well, I don't really. I think people can learn more from not the dogs, but the opposite. I think people can learn more from the winners. Speaking of winners, Drew, look at these stocks at all-time highs. We've got Pro Medicus,
They're all yours, aren't they?
Life 360. Passed on that one. Is that Life 360 or is that
Yeah.
Hub 24, which is the financial platform. GQG, never owned that. Lavisa. What's HMC?
That's the group that helped reverse float Chemist Warehouse.
Yeah. Origin Energy and A2 Milk. Geez, A2 Milk. Christ.
Yeah.
I've owned all of those except for GQG. And I only own one of them now, which is Pro Medicus. Fortunately, it's at the top of the list, so I'm happy with that.
Again.
Yeah.
That's for the financial
What
year.
can't it do?
Yeah.
So there were some questions that have come through live from Stephen and Mike on the chat, which we will get to in a moment. That's about Oz Super. We do actually have a question about Oz Super that's come through. But one of the things that I took a look at in the community recently, Drew, and I know you joined the other day, you joined under an anonymous handle. I noticed you joined the Rask community under a weird username.
Yeah, I'm not very good at tech.
So then what I did is I went through and corrected your name. So you're welcome. But I did put a post out.
What am I now?
No, I made it legitimate. Drew Meredith or Andrew Derrimouth. I did put a post out, which I
changed my password.
Can share in the show notes. But basically, CBA's Commonwealth Bank of Australia's earnings per share have gone up 12% in 10 years, and the dividends up are roughly the same. Yet the shares are up, as you put in this week's notes. The shares are up something like 45 or 50% this year. So it's a massive, massive expansion of the valuation and not much movement in the fundamental growth of the business, which obviously means that they can't keep doing that forever, or at least you'd think, unless the PE ratio goes to infinity. What do you make of that?
They have gone into and out of a lot of businesses over that period as well. And I think, why is it performing so well? It's just because, one, the nature of financial and services and banking in Australia, there's only 4 of them. They're incredibly supported by governments. Plus, that bank has by far has the strongest brand, regardless of what happened in the past. I think like 65, 67% is deposit funded versus having to borrow to fund their loan. So it's just a really strong franchise.
Would you buy CBA today if I said you can't sell it for 10 years?
Yeah, but I'd be stepping in.
No.
Yeah.
Today.
Today.
I'll ask Siri to set a reminder. Like 10 years. Siri probably won't even be here in 10 years. Siri will probably be telling me to set the reminder in 10 years.
Yes.
You would buy it today?
Yes.
Okay. Now I'll give you the choice. You get to buy CBA or ASX 200 ETF.
CBA, you're buying 10% of CBA if you buy the ASX 200 anyway.
Don't complicate.
And you're actually buying
ETF,
40. You're buying 40% banking sector.
No. Come on.
I'd take CBA.
All right. CBA or NASDAQ 100?
NASDAQ. For 10 years. For 10 years?
Yeah, 10 years.
Yeah, definitely.
Yeah. Did anyone else in the group say, that's online right now, sorry to everyone that's listening to this on Saturday morning, would anyone else take CBA over 10 years versus the ASX 200? If so, give me some reasons. Not saying it's right or wrong. Hey, I don't have a crystal ball. But what I thought was interesting is that...
Is this the Warren Buffett versus hedge fund bet? I think it is.
Yeah, you're the hedge fund. Yeah. I'm Buffett.
No, I'm Buffett.
Yeah, what's the Ted Seides? I got his book behind me. I haven't read it. So what I was going to say, I think that interestingly with CBA, you mentioned that they did make some divestments during pre-COVID. That's why I use earnings per share as the metric, not total earnings.
Yeah.
If you use total earnings, you're basically cherry picking the data, because of course CBA was making more profits when it was kind of gouging on financial planning fees and weird insurance fees and all those things, but it can't do that anymore. So that's why the total profitability of the business is down, but the earnings per share hasn't gone anywhere. And another thing that's interesting that I found when I was looking at CBA, Drew, was that the payout ratio, which is the amount of annual profit is paid out as dividends, is still not back to where it was before COVID.
It's like 85% before COVID.
But it's getting there. It's in the 70s and it's moving up to that. So meaning that they've probably got another year, maybe two, depending on how they treat it, of paying slightly higher dividends, but then they won't be able to pay anymore because they have to keep a amount of money for buffers and to run the business. So
that explains it too, doesn't it? That, you're paying out 85% of your profit as dividends. How are you ever going to grow your earnings at like a 10, 12% rate like CSL does if you're not reinvesting more?
But their argument would be, I'm suggesting, their argument would be that, hey, we're already the biggest bank in Australia. We can't take $5 billion a year and have a decent return. Like, it's not going to do anything for us. We may as well just pay it out with franking credits.
And your ROE expectation or your earnings expectation should be 5 to 7% on a company like that, probably.
Yeah. So if you reverse that question on me, I would take the ETF. But, I think anyone that's invested, you just should be mindful. If you invest just in a blanket ETF, like the stock market as a whole, you've got to know what's inside it and how they're moving. And that's something that's, it's up for debate. Pardon me. There was a question which I want to answer now because I can tell a few folks are anxious for us to get to it, which is the last question that came from analysis paralysis and sent in advance. Don't forget, you can set questions in using the show notes. There's a link in your podcast player if you're watching this or listening to this on Saturday. And if you're here live, you can just head over to the Rask websites and click in the menu. It's got Ask a Question, select the Australian Investors Podcast, or you can just jump into the community and have a chat with us 24/7. It's up to you. That's the community the URL is community.rask.com.au. It's pretty simple to remember. It's free. We don't know your personal circumstances, your needs, goals, or objectives. So if you do send in a question, keep your name anonymous and funny, and Drew will give you a copy of his book. There's still people asking for that, so just write into drew@waterpartners.com.au. He'll hook you up. And always seek the advice of a licensed and trusted professional before acting on the information, and read the PDS and the TMD, and there's a bunch of other things. You get the picture. Analysis Paralysis writes in and says, a common question, VGS or IVV? If someone chooses the world index, are you at a disadvantage? The fund's top 10 holdings are very similar with small percentage differences. Going quote unquote all in on the world to me means I'm diversified and there is not a need to buy 1 to 3 other ETFs to gain access to other markets. What is the thesis between IVV versus VGS? Is there a meaningful disadvantage or would someone be good with either? Drew, over to you.
They're actually not that much different. Like the size of American companies, I mean, the IVV tracks the S&P 500 and VGS tracks the MSCI, so a global index, the S&P being the American stock market index. There actually isn't that much different because of how big, at least at the top end, how big the largest US companies are. The Apples and Microsofts, the Nvidias are all multi-trillion dollar companies, so they dominate both. When we're building portfolios, we tend to prefer the MSCI World. It's slightly more diversified. The weightings at the top end aren't quite as high, and it has more exposure to a few other sectors like healthcare and a lot of those, a lot of the big healthcare and pharmaceutical giants come out of Europe versus the US, and are same as some of the bigger consumer companies or retail companies. So it really depends on which, on what specific exposure do you want. But I'd still be saying, even if you're buying these, don't think they're completely diversified. The top 10 companies in each of these is still going to be something like 30 or 40% of your investment. So there's always room for diversification in different areas around these, but they're incredibly good cores, both of them.
Yeah, good in the core.
Yeah.
I prefer IVV, so I'm a little bit different.
We disagree on everything today.
Yeah, we do. But I mean, you'd probably drink a Chianti if I'm being honest. So VGS has returned in total returns. So that's income plus capital growth, 13.4% over 5 years. IVV is 16.2%. Over 3 years, IVV is still a bit ahead. Over 1 year, anyway, IVV is winning the last 5 years. And if you think that the US market is about 75-ish% of VGS, meaning that the extra 25% of VGS is from everywhere but the US.
Pretty much Europe.
Effectively, what that's saying is those companies haven't performed as well as the US companies over 5 years. The same kind of holds true if you look back over 10, 20, or 30 years. The US stock market has been outpacing almost, as far as I know, every other stock market. If you go back 30, 50, or 100 years, or 120 years, I think it is, the Australian market actually is the number one in the world, followed by South Africa and then the US. But that might have changed since I last got my numbers, which is about a year ago. So basically what you're getting with the VGS ETF is a more concentrated exposure to America. But this is the thing, this is one of the reasons that I like it, is that a lot of places in the world don't have the same culture that Americans do towards business and innovation. And no one else in the world, country-wise, has the same military infrastructure that sits behind the globalization of those products. So imagine, for example, if America wasn't a dominant country from a defense point of view, from a cultural point of view, from a democratic point of view, from a technology point of view. If it wasn't all those things, businesses like Nike probably wouldn't be nearly as successful. Companies like, I don't know, Mars wouldn't be that successful. Companies like Apple simply wouldn't be that successful. And so not only should you be thinking about which countries are you exposed to, but which of those countries win and why do they win? I think a big reason that the US keeps on winning is because of that military infrastructure, because of the clear, distinct rules around property rights, which China obviously has questions over. It has a very stable democracy, although, it's pretty polarizing, especially the last 2 weeks. It's got also like, it's English speaking, which
entrepreneurial spirit.
Entrepreneurial. There's no tall poppy syndrome. And so the reason I'm saying all this is you can have exposure to that while also then just tacking on Europe or tacking on emerging markets, as Drew said, without having that big tail. IVV is significantly cheaper on a fee basis. I think VGS is a great ETF. It's simple, it's low cost, it can go in a core. I prefer to be more concentrated in terms of which places I want exposure to. And finally, the other thing is most people seem to forget this, that even though those companies are from the United States, so that's what you get in IVV, over 30% of their sales come from outside the United States.
Yeah.
So even though they say it's 100% US, it's really 70% US on a sales basis. So that's why I prefer it. That's my rant. Thanks for listening to my TED Talk.
Both aren't actually that diversified. That's the thing. You look at the returns from the S&P 500 in the last year, I think 2 years, and it's like, I think it's something like 70 or 80% from 7 stocks. That's why it's always about you use these, but you'll complement them with other things. So if you're using IVV, you might add some like a Europe ETF or a emerging markets or an active manager next to it. Because it can concentrate, then it shifts over time too.
Yeah, it's a good point. Pablo wrote in and said, if you have IVV, it's hard to have another global ETF without facing overlap risk, paying double management fee. Well, interesting, Pablo. If you think about it, you could have IVV and VGS in the portfolio together. So imagine you have $100 in your portfolio, and you know that 100, if you broke it straight down the middle, you would have and you put half in IVV, that would be 100% of that $50 in the US. If you took the same and you put the other 50 in VGS, you know that 75% of that is US. So effectively, you're looking at what, like $85 of your 100 is actually US. Now, if you did that, your fee would actually be less than just having VGS by itself, because the fee for VGS is 0.18 and the fee for IVV is 0.05, thereabouts. So even though there might be overlap, if you actually blended them together, you would still have some level of diversification. And I think another question, which is no one's asked this yet, which is like, well, why would you have IVV and not just go straight to the Nasdaq 100, which is like BetaShares NDQ? It's performed better than all of them. And I still think that that's a little bit narrow. Like I would have it in a core portfolio for sure, but I think it's a little bit narrow. With the S&P 500, you get a lot of industrials.
Yeah.
That's what I'd say about that. But these are really good questions, guys. So keep them coming in.
And we've had a pretty golden period for S&P 500 returns.
Golden.
Like and some of the things we get into when we're in, having conversations with clients is that they think that it's normal to get 22% returns from the S&P 500 or, average returns of 12, 13% from a balanced portfolio. I mean, historically, you're looking at 6, 7, 8% for a balanced portfolio as a whole, and equity markets 8 to 10 or, 9 to 11. So it's important, don't think that the index is going to keep producing, hopefully.
Yeah, 22% is a lot. That's unbelievable.
It's
Over 10 years.
Not something I'd be expecting.
Yeah. Yeah. Good questions, everybody. I was trying to look for, you said golden, which I'm thinking you just tried to plant that into our subconscious.
The golden years.
The golden years. I was trying to find where the book is. I think I did a ritualistic burning of it the other day. But there'll be plenty. Actually, there'll be plenty at the event in Sydney this coming week. This coming Thursday. For those of you that got tickets to the Waddle Partners event in Sydney, retirement event this Thursday at the Ramwick Racecourse. Thanks. I'll see you there.
Tickets closing soon. Yeah.
Tickets closing soon. He says.
Yep.
So yeah. If you're in Sydney this Thursday, retirement event, go to the Waddle Partners website. Check it out. Okay. So there was a question, not that one, from Virat Kohli. I know he's a long-term listener. Here we go. Prison Mike. Mike, is this you, Mike? As in Mike in the YouTube.
Prison Mike.
Prison Mike writes in and says, hypothetically, if you're lucky enough to inherit a $1 million property at 33, what's some possible ways to leverage / utilize this opportunity? Assume you currently live in the property. So we're not giving personal advice. This is purely hypothetical. And we don't know who Prison Mike is unless you know a certain Prison Mike, Drew.
I do not know a certain
Prison
Mike.
Okay. Just checking.
Is this a reference to Prison Break? Is it Mike Schofield or something from Prison Break? Or is that showing my age? Yeah.
This is why we're not in the same.
Highline is one of the best TV shows of all time, but yep.
It is very. I remember seeing an episode when I was younger. Not me, says Mike Smith from the chat. Okay. So, 33. Imagine you could go 30 years back, Drew, and be 33 again. You've got $1 million property. Let's assume it has no debt. So I think I asked you this question once before, but in a different way. What on earth would you do with it? It's a principal place of residence. You're a financial advisor.
I mean, the world's your oyster, isn't it? And it'll.
Is it?
Well, you basically got an asset worth $1 million. So the first thing is, what other assets do you have? What are your objectives? Where's your career going? You've basically got a really strong backstop. Obviously, something bad has happened for this to be receiving inheritance. But there's multiple ways. You can sell it, downsize, release equity. If you don't have any other debt, you could think about, borrowing against it and redrawing and starting to compound and build passive income. If it's your principal place of residence, that might be the best consideration, but then it depends on what your work position and your income position is. So it's and what your objectives are. Assuming you don't have another property, do you want to invest more? It basically gives you the flexibility and the ability to control your own future versus like a lot of us that are paying off mortgages to then have freedom in 10, 15 years time. I think most people are paying off their mortgages in their 50s. So you're 25 years ahead of most people. Is that a non-answer?
No, that's fine. I like it. And you did raise some things. I'm just going to digress from this because Rubes just put a comment in the chat, said Vanguard Australia lost its low-cost index fund investing in comparison to Vanguard US. The definition of low cost is below 0.1%, like IVV, not beyond that. I'm kind of the opinion that fees for investing have come down far enough that even I said before that VGS at 0.18 is expensive. It's not really, not in comparison to what we had historically, in my opinion. I'm happy to add that to a core. Would I add something to my core portfolio that's 1%? Not unless it was really, really different.
I remember when Vanguard used to charge 0.4 or 0.5%.
Yeah, it wasn't that long ago.
Yeah, no.
Anyway, so back to the question, which was around about $1,000 million of equity, you'll say, not 1,000 million. I sometimes run through this scenario in my head because I'm like, well, at any age, you could imagine that you're completely debt free and you've got assets. What would you do?
Get more debt.
Well, yeah. So some people that like say, I'd say start with the end in mind, and this is where you'd go for financial planning and goals and whatever. But if you were say 33 and you didn't want to retire for another 30 years, you love your job and you want to grow wealthy, you have a $5 million target. Well, you probably would look at like drawing equity out of that house and then investing that money, and then the interest becomes tax deductible, and the franking credits that you get are tax offsets, and you have this kind of like not debt recycling but equity release strategy.
Yeah.
But that's a high risk strategy.
It'll reduce your flexibility.
Yeah, and then you're stuck in the house. Do you want debt? And that's the whole thing. It's like, sure, you might have a goal, but how does that goal compare to your risk profile, how you want to spend your day? Like you might only want to work 2 days a week.
The other
In
option
this
is
case,
using
don't
your
do that.
income to save and save it that way rather than taking equity.
Yeah, and there's that many different things. We had someone write into us on the Australian Property Podcast, and they had multiple investment properties, and they only wanted to work 2 days a week, and they had $1 million of debt, and they realized if they sold the investment properties, they could probably afford to live like fine. But obviously, they were worried that they would be giving up their investment properties, which is a long-term asset for them, in order to feel more comfortable today. And I think it really just depends where you're at, what your priorities are. For me, I would be more inclined to use the equity because that's the type of person I am, and I'm pretty high, very high risk, you could say. But yeah, it's not for everyone. Good question though, and I would use ETFs probably, to be honest, and I'd probably have a core and satellite like normal. There were a few questions. Mr. basically said in the chat, MR, Mr. I'm going to go with that. Assuming NDQ is also an overlap with IVV, or basically the same. Yeah. So in NDQ, which is the NASDAQ 100 ETF from BetaShares, full disclosure, BetaShares sponsors our finance podcast. Yeah, you're going to get basically 100 of those stocks are going to overlap with 100 of the 500 in IVV. And you just got to be aware of that, and you can blend them together. That's as long as you're mindful of the overlap in your ETFs and your active funds and your stocks, you're halfway there.
It's more concerning is when you think you're diversified, but you're not, and you're buying multiple things, paying multiple fees, but not actually getting the diversification.
It's just a mess.
Naively, yeah.
Yeah. Okay, this one comes through from Virat Kohli, the Virat Kohli, former captain of the Indian cricket team, who happens to listen to the show. Big fan. Says, "Hi team, thanks for the lovely podcast and genuine information. I would love to know your thoughts about investing in water through the ETFs available in the US for a satellite position in a portfolio." He gives some examples and says they have costs of 0.5%. Any guidance would be appreciated. We'll talk about the satellite. How about that in general terms? And we'll say, first of all, Drew, would you invest in water? Yes, no?
Yes.
Okay.
There's a very soft yes.
It was a soft yes while also looking up into the top right corner.
Yeah. I was looking at this ETF.
It's like when a teacher asks you a question at school and you say yes, and it wasn't a yes or no question. Yeah. But would you use the US stock exchange to get exposure to one of these opportunities? It's in your satellite, so would you consider that?
I think it's an incredibly difficult question. I don't know I think when it comes to water, there is, as you were talking about before, the legal framework is so incredibly complicated that I would find it difficult to use a US version of that. I know enough to be dangerous. Like apparently you own the water from your land to all the way to the center of the earth. If you're in the US, not the center of the earth, but all the land below you for I don't know how far. But then in Australia, it's quite different, where your water rights allow you to pump water out of, and are much more heavily regulated. I think the story of water and the thematic of water makes sense, but I feel like it almost has to form part of a bigger thematic or satellite holding. So, the population keeps growing. We need more food. Food requires more water, and there's falling levels and scarcity of water. So that kind of makes sense. But what's the best instrument to execute it? And I think it's incredibly difficult. That's me with a non-answer.
Thanks for you sound like a stockbroker. I come in asking for an opinion. I went out more confused, but I did something in between.
Or a politician.
Yeah.
Anyway.
You just nod and yep, and then you walk out. So I would say no.
Well, this is the problem. Like this ETF, what exposure are you getting? It holds water utilities, infrastructure, equipment, instruments, and materials. Is that a
I didn't.
pure exposure to water? It's like a semiconductor, like an ETF that's whatever, like a particular theme, but it's only in semiconductors. Like it's you kind of want that if you're going to buy some of this, you want it to be the best expression of that theme that you can find, and that goes for
Amen,
every
brother.
asset class.
Best expression. You said it best.
There's my answer.
I love it. I feel like I just had deja vu. We've answered this question or similar related things before.
This is live, is it? Can you edit that question out?
No, I can't. No, it's official now. So I'm just going to put something in the chat for those of you that are live. If you're thinking Drew's onto something with water and whatever, you'd love this recommendation for a farmboxco.com.au, which is a organic food and vegetables. You get it delivered in the mail. It's a box of fruit and veg. It's a game changer because what I've noticed is that the fruit and veg from Coles and Morley are absolutely horrible. So that's my high conviction buy alert for today. It's fair enough. Now, anyway, as you were saying, if I was going to play something like this, it would be right out of the edge of my satellite. I'm doubtful that water pays dividends unless they're pumping the water out and that sort of thing. I probably wouldn't do that. The other thing is I probably wouldn't go outside of Australia to use an ETF like that. I think there's like 350 in Australia. There's also some water funds in Australia, like managed funds. Yeah. So I'd probably just go direct. Good question though. I just don't see the need. Would it? Because if you think about putting it in your satellite, you got to open a US brokerage account if you don't already have one. I know it's easier now.
It's going to be.
You're going to increase the complexity. You're going to have a little allocation of like 2 or 3 or 4%. And at the end of the day, is that worth it? Probably not, to be honest. For most people, that's a bit of a pain. Jeremy, welcome to the chat. He says, thanks for the ASA membership. Oh, you're very welcome, Jeremy. So very happy to help. The ASA, the Australian Shareholders Association, sponsor and supporter of the Australian Investors Podcast. Thank you very much. Did give away some ASA memberships. So if you haven't already supported the ASA, they're the largest not-for-profit for investors in the country. And they keep companies accountable. So if you care about things like corporate governance, the environment, the communities around businesses, go and have your say or not, and just join the ASA. It's free if you follow that email. Stephen, you said IVV in the core, FANG as a satellite. Drew, you had FANG.
I did. Still got it.
Do you think it's a satellite position or do you think it's a core position?
FANG satellite, I think, is so concentrated in one sector. High quality companies, but it's definitely satellite.
So you treat it as a quote unquote quality company investment?
Yep. Okay. No, I really treat it as a tech exposure, but they just happen to be 10 of the biggest companies in the world at the moment.
Cool. Jason on Facebook says Rubicon Water. It's in Shepparton. Hey, Shepparton. Shout out Victorians. I'm with you, Jason. Listed on the ASX, doing water/irrigation upgrades across the USA, Italy, and other parts of Europe. So that's Rubicon Water. I don't know much about it, but it's one for the watch list if you are interested in water. Thank you.
There was the Argyle Fund. I think it was Argyle Water Fund that came out of Blue Sky.
Yeah.
It's performing pretty well, but it's water rights. That's different.
Marco, I think you're responding to the question that I gave earlier on about the banks to everyone, which is like CBA or the ETF, and you said stick to the banks, so profitable,
Marco.
Lots more houses coming. You're on Drew's team, Marco, and go the Blues. Property prices increasing, bigger loans, bigger profits. Marco, yes, but it is more competitive in banking, and the big banks can only do retail banking now because they were booted out of everything else a few years ago. If I was going to go for a single bank play, not that I am, but if I was, I would go Macquarie Bank over the others. Tech, still diversified. Didn't even get mentioned in the Royal Commission. so they're like, oh, Macquarie's here. And the senators are like, oh, no.
Yeah, right. Wave them through.
Who's that? Okay, so we've got another question that's come through in advance from Real Dollars Not Making Sense. That's welcome to the 2 cents program. I invest in a growth portfolio of 6 ETFs, and one of those is BetaShares AAA Cash. I'm interested to understand why there is both a cash ETF and a cash reserve ready to be invested at any time within the portfolio. Oh, I think he's talking about, or she's talking about Rask Invest.
Ooh.
So, like, I just realized this. So we hold AAA in our portfolios simply because, well, it's a defensive asset and it pays good yield. But secondly, the reason is that when you invest with a platform or some type of investment group, typically you as the individual investor don't earn any interest from the cash that is held on your behalf. So let's say you invest in like one of those wrap platforms or one of the big investment platforms, you might have a 10% allocation to quote unquote cash. So your financial advisor won't just keep the money sitting there, because otherwise those platforms earn the interest and not you. So we do the same, and we use AAA, but it is also a strategic holding for us. There are other things, and interestingly, seeing that I'm in the business of making disclosures, over on the Australian Finance podcast in a couple of weeks, there's an episode with Cameron Gleeson from VGS, and he talks about all of the different sources of income you can get from an ETF, starting at cash and moving down to some exotic stuff. So that's coming up on the Australian Finance podcast. That's the blue one, if that makes sense. Now, there was a question I thought before from... yes. Okay. So Seals Travel, I think it is, said, "Hey guys, love your thoughts on a gold ETF." So maybe Drew, gold.
Long-term holders of gold.
Are you? What
Yeah,
allocation do you have to gold in the Waddle portfolios?
we had quite a while ago. We had like 10 to 12% of portfolios would have been our highest holding, but
Oh,
particularly for kind of
you
sophisticated
start
clients.
burying it in your backyard if you
Um,
get any more.
but now it's like, and there's a lot of different ways to buy it. We're probably around like within our alternatives bucket, we're probably around 3 to 5% in gold still, and it just hit another all-time high. And we were talking about before the impact that it's impacted by both currency, and therefore, if you're buying in Australian dollars, well, a weaker Australian dollar sends the gold price in Australian dollars higher. So you've got a hedge against or something that's going to be influenced by currency, by interest rates, by inflation, as well as the price of gold. It's just continued, despite everyone expecting it to fall as interest rates went up and you could get income elsewhere. It's become kind of returned to that safe haven, and it's always seen as an inflation hedge, but it doesn't correlate directly with inflation. I think it's just a scarce asset, and what we're in the pursuit of is any type of asset for retiree portfolios that have non-correlated returns. So something that'll react differently in different market environments, and that's what it's continued to do. We've bought gold directly at the Perth Mint, allocated or unallocated. I think there's probably 4 gold ETFs now. So the Global X was the first, been around for a while. It used to be ETF Securities, and probably the biggest.
It is the biggest.
And that holds physical gold underlying. I think there's a synthetic one, which means they hold gold futures. And then I know iShares recently launched their own gold, and I know BetaShares has a hedged one. So the big question you start to have when the Australian dollar is quite low is it time to hedge your gold position so that if the Australian dollar increases, you're not going to lose money solely because the currency is moving. But non-correlated returns has performed well historically, and as you know, income plus growth equals total return. So
Oh,
you can't always
one of the
rely
golden
on
rules.
income and dividends. Exactly.
Here we go again.
And
Yep.
and growth doesn't have to come from growth stocks. It can come from things like precious metals.
Mm-hmm.
There's my rant for the day.
That's precious metals. Yeah, there you go.
Not a gold bug.
There are not a gold bug. These are the top ETFs in the country as of June 2024. The Global X Gold ETF, GOLD, is by far the biggest with $3 billion invested.
Yep.
The next biggest is
unhedged.
That's in US dollars, meaning
Yep.
The Perth. It's on the Australian Stock Exchange. Let's not confuse people, but the gold is fluctuating in US dollars. So that's why it goes up faster when certain things happen. PM Gold, that's the ticker symbol, is the Perth Mint Gold ETF, is $875 million invested. That's also in free float, like it's also in US dollars.
Unhedged, yep.
Unhedged, sorry. QAU from BetaShares is in third place with $565 million invested. That is currency hedged, so that will probably get more popular right now. The next biggest is the iShares Physical Gold ETF.
GLDN?
Yes, GLDN. That is $157 million invested. The NUG ETF from Van Eck, which is just a pure gold bullion ETF, is $62 million. And the most recent one, which is not... so Global X, given the popularity of their main gold ETF, they actually brought out a new one, GXLD, which is also a gold bullion ETF. So they've got two gold bullion ETFs on the ASX. GXLD is cheaper,
Is it
0.15. It's unhedged.
smaller increments?
Yeah, it's tiny. It's got about $2 million invested. So that would grow quickly, I think, from here. Okay, so probably got time for one or two more. Jeremy did ask a question before. Oh, and Drew, can you give a few examples of ETFs that are completely different from one another? So when one might be impacted, the other might be free of the impact. Asset classes, I guess, is the term. So basically things that are moving in completely opposite directions. Jeremy, there are that many things that in every market, in fact, I don't know something in every market that moves always in the exact opposite direction. But what we're looking for, the term you're describing is correlation, and it's how things move together or not. And if it's a negative correlation, it means they move in opposite directions.
So I'd look at bonds, fixed income, infrastructure. Someone put DGRE, so Dow Jones Global Real Estate Index, global property. Just look for most of them are still investing in listed products, but gold's one of them. Just equities, most equity markets are going to trade similarly to equity markets. So how do you find anything and you can see all their data will show how they've correlated historically. There's some private equity LICs you can buy as well. And it's just knowing what the risk profile of each one is and how it has reacted with the other. So if you're super growthy, then you're probably something as simple as fixed income can be a good counter for that as well.
DGRE, which is what Luke mentioned over on Facebook earlier on, which is the SPDR, Dow Jones Global Real Estate ESG Fund, DGRE. So basically what Drew was talking about before when he said infrastructure, I don't know what other things, gold, whatever, he was saying from the perspective of a share market investor.
Yeah.
So if you think about if your share market portfolio is how you think about investing, what are all the things outside of that move in a different direction? So yeah, infrastructure, gold, and all the other things that he just said. But what tends to happen over the past 15 years is a lot of those things in a crisis have moved in tandem, which is if you go back over 50 years, you will find that gold doesn't move in the same way or bonds don't move in the same direction. But in the last 15 years, since the GFC, nearly 20 years, they have started to move together in times of crisis. So some of the time, they're actually not making sense. However, cash as an asset class is really powerful in my opinion. Cash being like term deposits and savings accounts, assuming the bank doesn't go belly up, which is very unlikely. That's basically got like no correlation to anything because it's just in your account. It doesn't go up or down. It just keeps ticking over. So that's a great natural counter to most asset classes, which is really really good. Alan, you just said, just started watching. Have I missed the part about IVV or VGS? Currently thinking if I stay with Australian Super DIY for international shares following Misky World or do it members direct buying IVV. Alan, that is about 20 minutes ago. So maybe once we're done, you might want to go back to that. Probably about 15 minutes into the chat, we started that. But Calvin, you mentioned the IXJ Health ETF. Yeah, that was one of the first ETFs I ever bought, actually. I think it's a respectable ETF, global healthcare thematic, more of a sector rather than a thematic. Okay, so Drew, get your dad joke ready because we might have to go
getting that ready. I nearly forgot.
Go off into the sunset. But I did say that we did have a question about Australian Super. Now I can't bloody find the thing. We did have a question that came through about super funds. I can't find it now, so maybe we'll have to table that next week. But basically, a lot of people have asked Drew in the chat about using ETFs inside their industry funds, using things like Member Direct, these types of things. Obviously, you have some flexibility with super funds and using their online portals to go and buy your own things. I'm of the opinion that you need to be very careful with that sort of thing. So make sure you are being prudent. It sends kind of like shivers down my spine when I hear of people buying individual stocks with their super funds.
Yeah.
I think that's a big, I don't actually think that may be prudent for like the 99% of people. So
have a strategy, have a framework, and that's the
Yeah.
problem with being so self-directed in your retirement savings is even if you have your own framework, doesn't mean you need advice, but seek advice, but build something so there's a reason behind each holding rather than you putting your kind of retirement life at risk at different points.
Yeah, it's choose low cost, choose diversified. Sure, if you're going to don't go down that path, like Mike said, I'd love to see the Australian Super offer a subset of listed ETFs as an option outside of their member direct. I think that we're going to see more of that in a way, Mike. Like we've seen, like Host Plus come out with their super low index diversified option, and then you've got Rest Super came out with zero fee investment options, which are index options. Aussie Super's got an investment option, which is premix, kind of like your Coke at a pub. You take it as it comes. That's also pretty low fee strategy. Obviously, when I talk about fees and super, quick bit of education. We talk about the strategy as having the fee. There's an investment fee for the strategy. The overall super fund also has an admin fee. So don't confuse them and don't confuse insurance.
And no advice fee because they don't provide advice.
No, they don't provide advice. So, yeah, I hope that makes sense. We could petition, Mike, you and me, a couple of Australian super users amongst the 2 million or 3 million or however many million they have. We should petition them and say, hey, give us the option. It would make sense, but obviously they've got commercial reasons perhaps for not making it as easy as they might do. So, Jeremy, I can see your question. Do you mind throwing that over into the Rask community? You know how you like to invest in companies you buy from. NDO, wondering if a tiny stake might be interesting. Let's just have a quick look at this. Oh, Nido Education. This is the education business. Yeah. Oh.
Oh, we never got to Zip either.
Oh yeah, quick. Okay,
That's
give us
my
the 30
joke.
seconds on Zip. Go for it.
Capital raising, paying off debt, and pivoting. Going for growth in the US. So
Going for growth.
maybe that $10 note you mentioned might still be possible.
Did they did they use that exact language? Did they say going for growth?
But I believe so. And they
Going for growth.
essentially, so they're raising about 200 million to pay off debt. They're going to pay an early break fee. So it sounds like you don't go and raise to pay off debt unless you've already got the support of brokers generally. And
This
they've talked about
this is a rocket ship, Drew. Look at that.
don't go to 5 years, please. Oh, there we go.
5-year chart looks negative, but for 1 year it's up
lesson.
285%.
This is a good lesson. If you put a chart on the right time frame, you can make it look like anything. So always be careful when you're looking at investment presentations.
Oh yeah,
They had
cherry
an
pick good
interesting
times.
thing, which was they're doing a pay by 8 for larger purchases, so you can get your business class flights. Owen, next time.
Pay in 8 installments.
Yeah, rather than 4.
Oh, great.
Yeah,
Well, put yourself in debt. That'd be wonderful.
Yeah, exactly. That sounds beautiful.
Yeah, to the moon. Yep.
To the moon.
Never again.
Over 12 months. Recover my money in another 3 years.
You're doing better than me, mate. So we don't need to mention the name of my company that has since been connected to some underworld things.
Really?
Yes.
Oh God.
Anyway, I'll leave that for people that listen to the show regularly to remember. But you know who I'm talking about. Drew Meredith is a director at Wattle Partners Financial Planning. It's wattlepartners.com.au. You can follow the link in your podcast player, or you can head to the RAS website, which is financial planning. Get matched with a financial advisor. So you can send Drew, if you got your question on the show today and you haven't already got a copy of his book, The Golden Years, Spend It All, you can go and get that by emailing him, drew@wattlepartners.com.au. But seriously, the book is not called that, and you can get it on Major Street Publishing website, as well as I'm sure it's on Amazon or whatever. If you're in Sydney,
most gifted book in wealth management on Amazon.
Second most gifted book
in wealth management.
In wealth management. How do they come up with that? Like, how do they know that it's gifted?
I don't know, but Jamie just read it as being the second most gifted book on Amazon.
Gifted.
Yeah. But selling like hotcakes, apparently.
Yeah. Gifted. I wonder if that could be interpreted differently. Like, you know how everyone thinks their son or daughter's gifted, and then you look over, they're tripping over the soccer ball. But maybe I'm being cynical. No, it is a great book, and you can get it. And if I see you in Sydney this coming week at the Wattle Partners retirement event, that'll be great. It'll be good to catch up with people, have a coffee, have a chat about investing. So head to the wattlepartners.com.au website for tickets and to learn more. Drew, you've got to take us off into the sunset with a bit of a dad joke. What do you got?
I'm leaning on a client who sent some through this week, and I'm going to go something a bit longer.
Oh, okay.
Here we go. So 2 cups of yogurt walk into a country club. We don't serve you kind here, the bartender says. Why not? One yogurt asks. We're cultured.
Well, feel free to give him a score now that we're just doing this live on YouTube. Feel free to give him a score before we head off and get on with our weekends.
At least I'm not singing this time.
Yeah. Well, that's fair. Warren Buffett famously was asked what was inside his wallet, and he came up with a bunch of different stuff. But I'll tell you what's inside my wallet while we wait for that feedback. I've got a Virgin Velocity loyalty card, an ING card,
1 out of 10. Ouch.
a Costco wholesale card, an Anaconda card, my gun license, and Medicare card. There you go.
Well, that's a flex, isn't it?
It's just a subtle flex. Anyway, dad jokes. Here we go. Scores 1 out of 10, 1.5 says Bronx, 3 out of 7 says Mike. That's some fractions I haven't done for a long time. 8 out of 10 says Jeremy. That's Jeremy's. You're paying him off. All right, guys. Thank you so much for joining us live. Thank you, everyone who listens on Saturday. It's good to be back recording 2 cents on the Australian Investors Podcast with the man, the myth, the legend, Dr. Andrew Deremuth. Don't forget, if you did get your questions in, you can get a copy of the book from him and Jamie Nemesis. Mate, always a pleasure. So thanks for joining me.
Good to see you.
Bye for now.